On a Friday morning in March of 2023, employees at hundreds of tech companies across the country woke up to find their company's bank simply didn't exist anymore. Silicon Valley Bank, one of the largest banks serving the tech industry in America, had been shut down overnight by regulators. Payroll was due in days. Some companies genuinely didn't know if they'd be able to pay their employees. Founders were posting in group chats trying to figure out if their entire operating cash, sometimes millions of dollars, was simply gone. It ended up working out for most of them, but only because of a rescue that almost didn't happen. And the whole event is the reason I now follow one specific rule with my own savings that I never break. I never let my savings sit entirely in one place, no matter how much I trust the bank, no matter how convenient it would be to just keep it all in one account. I'm going to show you exactly what happened to the companies and individuals caught on the wrong side of that Friday morning, and exactly how to protect yourself from the same thing without making your financial life more complicated than it needs to be. If you're new here, hit subscribe. I break down exactly this kind of thing, the habits that quietly protect people's money from risks most people never think to consider, every single week. Here's the rule. I never keep more than $250,000 in cash at any single bank. That number isn't arbitrary. It's the exact limit of what the FDIC, the federal agency that insures your bank deposits, actually guarantees per depositor, per bank. Below that line, if your bank fails, the federal government has guaranteed your money back, dollar for dollar since 1933, and that guarantee has held every single time, without exception, for over 90 years. Above that line, you're no longer a guaranteed depositor. You're a creditor, standing in line with everyone else the bank owes money to, hoping the sale of its remaining assets covers enough to make you whole. Most people watching this aren't sitting on anywhere close to $250,000 in cash, and if that's you, this might feel like it doesn't apply yet. But here's why it's worth understanding the mechanics now rather than the week your own savings finally cross that line. Because that's precisely the week you won't have time to research it properly. And it's also worth knowing that this same rule protects you in smaller, more immediate ways long before you ever get anywhere near the actual limit. Let me tell you what actually happened to Silicon Valley Bank's customers, because it's a genuinely instructive story about exactly how thin the line between fine and catastrophic can be. Silicon Valley Bank's failure ended an unusual streak of over 800 days without a single U.S. bank failure. It was, at the time, the second largest bank failure in American history, holding over $200 billion in assets. 2 days later, Signature Bank failed as well, another lender known for serving startups and the tech industry, with over $100 billion in assets of its own. Less than 2 months after that, First Republic Bank went down too, becoming the second largest bank failure ever recorded, even bigger than Silicon Valley Bank had been, and the third of these 3 collapses inside a single 10-week stretch. 3 of the 4 largest bank failures in American history all happened within about 2 months of each other, which is exactly the kind of clustering that should make anyone reconsider how rare this risk actually is. Here's the detail that should genuinely concern you. At First Republic specifically, 68% of all deposits sitting in that bank were not covered by FDIC insurance, meaning the vast majority of the money sitting there belonged to depositors who had exceeded the $250,000 limit and had no guaranteed protection at all if the bank went down for good. That wasn't a fluke of one unusual bank either. It reflected exactly the kind of clientele First Republic specialized in. Wealthy individuals and businesses who'd simply never thought to spread their cash across more than one institution, trusting a well-regarded private bank the same way most people trust whichever bank happens to be nearest to them. What actually saved those depositors wasn't the insurance system working as designed. It was a discretionary emergency intervention. Regulators, worried about a wider panic spreading through the banking system, took the unusual step of guaranteeing all deposits at Silicon Valley Bank and Signature Bank, insured and uninsured alike, and JP Morgan Chase stepped in to acquire First Republic's deposits and assets entirely, which meant every depositor there, insured or not, ended up made whole in the end. That is genuinely good news for the people involved. It is not a system you should plan your own finances around, because it depended entirely on regulators deciding in the moment that this particular failure was large enough and dangerous enough to justify stepping outside the normal rules. The standard rule, the one that applies to almost every bank failure that doesn't threaten the wider financial system, is the $250,000 limit and nothing more. Here's what that standard rule actually looks like when regulators don't step in with an emergency rescue. A small Oklahoma bank called First National Bank of Lindsay failed in October of 2024. Around $2.8 million in deposits, there exceeded the FDIC insurance limit. The FDIC didn't guarantee that excess the way it did at First Republic. It said it would determine later whether uninsured depositors would get any of that money back at all. At a similar failure the same year, uninsured depositors initially received only 50% of the amount that had exceeded their coverage, with the possibility of more later depending on how much the FDIC could recover by selling off the failed bank's remaining assets. That's the actual, ordinary outcome for money sitting above the line when a bank fails without a headline-grabbing emergency rescue attached to it. Not zero usually, but not guaranteed, and not necessarily fast. For a depositor waiting on that recovery, the uncertainty itself is often the hardest part, not knowing whether the eventual number will be 50%, 70%, or something else entirely, and having no real say in the timeline while the FDIC works through selling off whatever assets remain. I want to be clear that bank failures are not some rare, once-in-a-generation event, even though it can feel that way given how much attention 2023's failures got. A bank failed in this country this year already. 2 failed last year. 2 failed the year before that. In most years going back decades, at least one bank somewhere in the country has failed. It's not common enough that you should feel anxious about your everyday banking, but it's common enough that treating your bank as a place that simply cannot fail ever under any circumstances isn't actually supported by the historical record, even if it's how most people quietly think about it without ever examining the assumption. It's worth understanding why these failures happen at all, because it's rarely dramatic in the way people imagine. Most of the smaller failures you've never heard of come down to fairly mundane causes: a concentration of bad loans, allegations of fraud in the bank's own records, a sudden capital shortfall that regulators decide can't be fixed in time. The 2023 failures were different in scale but similar in mechanism. Banks that had grown quickly concentrated their deposits and investments in ways that looked fine until interest rates moved sharply and exposed the mismatch all at once. None of this requires you to become an expert in bank balance sheets. It just means the assumption that any given bank, including yours, is simply too stable to ever fail isn't something the actual historical record supports, no matter how solid the building looks or how long the bank has been in your town. There's a second reason to spread savings across more than one place that has nothing to do with the FDIC limit at all, and it matters even if you're nowhere close to $250,000. When a bank fails, even fully insured depositors typically get access to their money again within a day or two, once the FDIC arranges for another bank to take over the failed one's accounts. A day or two doesn't sound like much until it's the exact day or two your rent is due, or your business needs to make payroll, or a medical bill needs to clear. Having your entire financial life routed through a single institution means a single point of failure can briefly freeze every single dollar you have access to, insured or not, for however long it takes the system to sort itself out. This applies just as much to a bank simply having a major technical outage or a fraud-related account freeze as it does to an actual failure, which means the practical benefit of this habit shows up far more often than the headline-grabbing scenario of a bank collapsing entirely. Let me walk you through what this actually looked like for one person. Take a man I'll call Thaddeus, 56. Sold a business 2 years ago and had roughly $400,000 sitting in cash at a single regional bank while he figured out what to do with it long term. He genuinely hadn't thought much about where the FDIC limit sat, assuming, the way most people do, that a bank simply doesn't fail, especially not one that had been around for decades in his community. When that same bank ran into serious trouble the following year, $150,000 of his balance sat completely outside FDIC protection. The bank ultimately didn't fail. It was acquired in a last-minute deal before regulators had to step in, and his money was fine. But he told me the 2 weeks where that outcome was genuinely uncertain were the most stressful 2 weeks of his financial life, watching local news for updates on a bank he'd never once worried about before, doing math in his head about what percentage of his life savings might simply not come back. What made it worse, he said, was how little he could actually do about it once the situation had already developed. Moving $150,000 during an active crisis at the bank holding it isn't nearly as simple as it sounds. Wire transfers can slow down or freeze entirely once a bank is under serious regulatory scrutiny, and pulling money out in a panic alongside other worried depositors is part of what actually accelerates a bank's collapse in the first place. He genuinely didn't know, in the moment, whether trying to move the money would even work, or whether it might make his own situation worse by drawing attention to a large withdrawal request at the exact moment the bank could least afford one. That powerlessness, more than the money itself, was what he said he never wanted to feel again. He moved the excess to a second bank within a month of that resolution, and he told me the peace of mind alone was worth the minor inconvenience of managing 2 relationships instead of 1. If you've never actually checked whether your own savings sit under the FDIC limit at your bank, comment below with roughly how close you think you are, because I think a lot of you have genuinely never done this math before, and it takes about 2 minutes once you sit down and actually add up everything sitting at a single institution. So here's exactly how to think about protecting yourself, whether you're nowhere near the limit yet or getting closer to it. First, the FDIC runs a free calculator at their own website called EDI, the Electronic Deposit Insurance Estimator, where you plug in your account types and balances, and it tells you exactly how much of your money is covered at a given bank. It takes about 5 minutes, and it accounts for details most people don't know matter, like the fact that coverage is calculated per ownership category, which means a joint account with a spouse is actually insured separately from your individual account at the same bank, effectively doubling your coverage at a single institution without opening a single new account. Retirement accounts, trust accounts, and business accounts each get their own separate coverage category too, which means a household with a checking account, a joint savings account, and a couple of retirement accounts, all at the same bank, can genuinely have well over $1 million fully protected without ever touching a second institution, provided the accounts are actually titled correctly to claim each separate category. Second, once you are approaching or past the limit at one bank, the simplest fix is exactly what it sounds like. Open a second account at a genuinely separate institution and split the balance. Some banks also offer network programs that automatically spread large deposits across multiple partner banks behind the scenes, all while you interact with what looks like a single account, giving you FDIC coverage well beyond the standard limit, without you having to personally manage several separate logins and separate debit cards. These programs exist specifically for people who want the protection of multiple banks without the hassle of actually managing multiple banking relationships day to day. And they're worth asking your own bank about directly if the idea of juggling several separate logins is what's been stopping you from doing this already. Third, don't wait until you're right at the $250,000 line to start thinking about this. Building the habit of keeping meaningful savings in at least 2 separate institutions, even well below the limit, means you're never scrambling to figure out the mechanics for the first time during an actual crisis, and it means a single bank's technical outage, fraud freeze, or temporary account lock never leaves you with literally zero access to any of your own money at the exact moment you need it. Think of it less as a rule that only activates once your balance crosses a specific threshold, and more as a habit worth building the same way you'd build any other financial habit, gradually before the moment it's actually tested arrives without warning. Let me leave you with someone who had this already in place before she needed it. A woman named Rosalind, 61, recently widowed, inherited a life insurance payout that pushed her cash savings well past $300,000 almost overnight. Because she'd already been in the habit of keeping her savings split across 2 banks for years, purely out of the general caution her late husband had always insisted on, she simply opened a 3rd account the same week the payout landed and divided the new balance across all 3 without a second thought. She told me it took less than an hour total, an amount of time that felt almost embarrassingly small given how much money it was actually protecting. When her original bank was acquired by a larger one 18 months later, a stressful and uncertain process for a lot of the bank's other customers, she told me it barely registered for her financially, because no single account held enough to matter if anything had gone wrong. What she said stuck with me was how differently she experienced that acquisition compared to friends of hers who banked exclusively with the same institution. They spent weeks anxiously reading news updates, calling customer service lines that stayed busy for hours, genuinely unsure whether their day-to-day banking was about to change, or whether their money was fully safe throughout the transition. She read the same news, but from a position where the outcome, whatever it turned out to be, was never going to threaten more than a third of what she had. The acquisition ended up being a routine, well-managed transition with no losses for anyone, but she said the calm she felt watching it unfold had nothing to do with luck. It came entirely from a decision she'd made years earlier, for reasons that had nothing to do with predicting this specific event, that simply happened to be exactly the right preparation for it when it eventually arrived. That's really the whole point of this video. Banks are safe the overwhelming majority of the time, and FDIC insurance genuinely works exactly as promised for the money it covers. But the habit of spreading savings across more than one place isn't really about distrust. It's about recognizing that a system which has worked perfectly for 90 years still has a specific published limit, and treating that limit as real, rather than assuming it will never apply to you, is the entire difference between a stressful 2 weeks and a genuine crisis, if the 1 year your bank happens to be the exception ever actually arrives. I don't think of this as pessimism about the banking system, even though it can sound that way described out loud. The FDIC's track record really is remarkable. 90 years without a single insured depositor losing a cent is not a small thing, and it's a genuine reason to trust the system broadly. But trusting the system and trusting any single institution within it are 2 different things, and the entire design of FDIC insurance, a specific dollar limit rather than an unlimited guarantee, only makes sense if you actually respect the boundary it draws. Spreading your savings isn't a bet against your bank. It's simply taking the government's own stated limit at face value, instead of assuming it was written for someone else's money and not yours. I'm Faisal. Thank you for listening to Sheikh Faisal.